Hi, my name is Felix Ortiz Rivera, and I am licensed mortgage lender for the state of Florida. Thank you for watching my channel and to let you know what is the forecast with interest rate and house pricing for the near future. Ever wondered what the future holds for mortgage interest rates? Well, you're not alone. These rates play an essential role in the housing market, and understanding them can make all the difference when buying a home. They're influenced by a cocktail of factors, from the state of inflation and the bond market to housing market conditions, and even the policies set by the Federal Reserve. Intriguing, isn't it? So don't go anywhere. Stick around as we delve into what influences these rates and what we might expect in the future. You might be wondering, what exactly influences mortgage interest rates? Well, let's dive into it. Mortgage interest rates are like a complex web, spun by various factors that can either tighten or loosen its strands. Firstly, inflation plays a pivotal role. When inflation rises, the purchasing power of money declines, and lenders demand higher interest rates to compensate for that loss. So if you see inflation on the rise, brace for potentially higher interest rates. Secondly, the economy has its say. A strong economy tends to drive up interest rates as people are more willing to invest in higher-risk assets, while a weaker economy can lead to lower rates. So the state of the economy is like a weather vane for interest rates. Government policy also weighs in, particularly the Federal Reserve's control of the federal funds rate. When this rate goes up, banks and other lenders usually hike their own rates, including those for mortgages. Now, let's talk about some factors within your control. Your credit score, for instance, can greatly influence your mortgage interest rate. A higher credit score typically translates into a lower interest rate. It's like being at the front of the queue at your favorite coffee shop. You get served first and with the best selection. Your down payment can also influence the interest rate. The more you put down, the less risk for the lender, leading to a potentially lower interest rate. It's like buying in bulk. The more you buy, the lower the price per unit. Lastly, the term of your loan matters. Shorter-term loans often have lower interest rates than longer-term ones. Think of it as a sprint versus a marathon. The faster you run, the sooner you finish. So, as you can see, a variety of factors influence mortgage interest rates. But what does this mean for the future? Now that we know what influences mortgage interest rates, let's make some predictions about the future. The roller coaster ride of rates has been quite a journey. From the effects of the global pandemic, which saw rates fall significantly in 2020, to a rise again in 2022, the mortgage landscape has been anything but predictable. This year, we've seen average interest rates for 30-year fixed mortgages and 15-year mortgages hover around 6.94% and 6.20% respectively. That's quite a leap from the low of 2.65% we saw in January 2021. But what does the crystal ball show for the future? Well, forecasts suggest a change in the wind. Rates are expected to start dropping again towards the end of 2023. Imagine that, a dip in the roller coaster just when we thought we were climbing to the top. But what does this mean for you? Lower rates could mean lower monthly payments, making homeownership more accessible for many. However, it's important to remember that these are just predictions. Mortgage interest rates can be as unpredictable as the weather. They are influenced by a multitude of factors, from inflation and housing market conditions to Federal Reserve policy and even global crises. So while we can make educated guesses based on current trends, always keep in mind that the mortgage market is a complex entity, and rates can change. The key is to stay informed, monitor the market, and when the time is right, secure the best rate for you. While these are educated predictions, remember that mortgage interest rates can be unpredictable and are influenced by a variety of factors. So what does all of this mean for you, the home buyer? Let's pull it all together. Mortgage interest rates are influenced by a myriad of factors. These include inflation, the state of the economy, your credit score, and the type of loan you choose. The Federal Reserve also plays a part, controlling the federal funds rate, which in turn affects mortgage rates. Remember, rates fluctuated in the past, hitting a low of 2.65% in January 2021. Due to the coronavirus crisis, they began to rise again in 2022, but predictions suggest a drop towards the end of 2023. Considering these factors and predictions can guide you when you're thinking about purchasing a home. And don't forget, shopping around can also help you nab the best rates. It's recommended to get quotes from multiple lenders to ensure you're getting the best deal possible. Remember, understanding mortgage interest rates can help you make an informed decision when buying a home. Thank you for watching.